Hello and welcome to another episode of What to Know. My name is Amavi Gamon. Today we are discussing credit scores. What makes up a credit score? What helps or hurts your credit? And some common misconceptions. Today I'm joined by Alvaro Marcias. He's the Vice President of Community Development at Acentra Credit Union. Alvaro, why don't you tell us a little about what you do?
Thank you, Amavi. I'm in charge of our community outreach. I teach financial literacy presentations throughout the community. I work with local organizations to help people who might be underserved or communities that don't get a lot of this information get the services that they actually need. One of the classes I teach is that's very common is about the credit score. Because here in the United States, it's something that affects almost everyone eventually.
Credit scores are very important. Can you tell us what a credit score is and why it matters?
Absolutely. A credit score is a number between 300 and 850 that tells lenders how much they can trust a borrower to repay their debts. It's important because you need credit to buy a house, a car, or to get a credit card. But it's also used in some instances to qualify to rent a house, an apartment, or even to get a mobile phone.
What makes us a credit score and how does someone start to build it?
A credit score is made up of 5 different factors, each with their own level of importance. I'll break it down further, but the 5 things that make up the credit score are payment history, the capacity, the length of credit, the mix of credit, and debt accumulation. So your payment history has the biggest effect on your credit, making up 35% of the score. That measures your on-time payments and any late or unpaid payments, and it doesn't matter what the amount is. Now, a lot more focus is put on the recent payment history, so older missed payments become less important over time.
So how long will missed payments affect your score?
That's a great question. It takes about 2 years for your score to recover from just one missed payment. But any unpaid bill that is reported to a creditor or a credit reporting agency will stay on your credit report until it's paid. So once a debt is paid off, it will stay on your credit report for 7 years. So you want to make sure you're on top of how much you owe anybody out there.
That's good to know. So what's the next most important part of a credit score?
That would be the capacity, which makes up 30% of your score. Now, your capacity measures how much of the credit that you have available that you're actually using. And it's really important to make sure that you're on top of how you're using that credit that is available to you. You don't want to overuse it. You want to make sure you use it wisely.
What will be a good capacity usage look like?
It's recommended that you don't use more than 30% of the credit that you have available. The more credit that you use, the more likely that your credit score will drop.
So you're saying that it's that important not to max out your credit lines?
Exactly. You really want to avoid just using every credit available to you. That's not good for you. The next thing that's important is the length of credit, which makes up 15% of your credit score. Now, that's an average of all your open credit lines a borrower has. That's why it's important not to close credit lines that you've had for a very long time or open too many new ones in a short amount of time, because it will affect your average. Opening up several new accounts in a short amount of time affects a borrower's debt accumulation, which measures the number of hard inquiries and debt added in the past 12 to 18 months. So each hard inquiry will affect your score, so you should avoid having more than 3 inquiries a year. That's a good rule of thumb.
Wow. You said hard inquiry. What does that mean?
Yes, a hard inquiry is when a creditor checks your credit report because you have applied for a new credit or a service, and it can lower your credit score by up to 10 points. There's also another version called a soft inquiry, where your credit score is checked, but it does not damage your credit because you have not applied for the credit.
Thank you for clearing that up.
Of course. The last part of the credit score is the mix of credit. There are 2 most common loans for borrowers to apply for, and they're installment loans and revolving loans. Now, the difference is an installment loan is like a mortgage or a car loan. where you have a set number of payments for a specific length of time before it's paid off. Usually could be 36 months or 60 months, 72 months. Now, revolving loans are like credit cards where the balance can be added at any time. So you can take a credit card and really start using it whenever you feel like it. And there's no end date. It's not like it's going to be done at a certain time. You can use that card over and over and over. That's why it's called revolving.
So what will you say is the best kind of credit to have?
Really, installment loans are better for your credit score, but having a good mix of credit is best. Having more revolving loans than installment loans will hurt your credit, though.
That's good to know. You mentioned earlier that there are some misconceptions of credit score. Can you explain what those are?
Sure, the most common misconceptions are the debt to income ratio and the length of employment of residents. Some people might think that their credit is affected by how much money they make or how many expenses they have, and that's really not the case. It will not affect your credit score. There are some people out there that make a lot of money but have bad credit. And there are people who don't make a lot of money or live paycheck to paycheck and they have great credit. Now, your length of employment and how long you've lived someplace doesn't affect your credit score whatsoever. Now, while they don't affect your credit score, it doesn't mean that those things will not impact whether you qualify for a loan or how much a lender is willing to offer you in credit. But keep in mind, it does not affect your actual credit score.
What recommendation will you give to someone who is looking to start building their credit or looking to improve their credit?
So for somebody who's looking to start to build credit or to improve it, I would recommend applying for a low interest rate credit card through a credit union, something that they could charge some expenses like groceries or maybe gas, something that they can actually pay off every single month. So they're using credit but paying it off, not getting in debt, right? So that can really help you. That can pay, that not only can help you at that time, but it can help you in the long term. It's a good idea to talk to a financial coach as well. So depending on your goals, they can help you. And at a Central Credit Union, we do have financial coaches that are available to meet with our members for free. So it's a great benefit that they can take advantage of. And they can actually look at your credit, do a soft inquiry, and go through it piece by piece to figure out what needs to be done in every specific situation. Obviously, everybody has a unique situation, and they can basically put a plan together for that individual. Lastly, monitoring your credit score. There's mobile apps that you can use. There are various options out there, but the Centra Credit Union app has a tool called Savvy Money that gives members a look at their credit report and credit score. It also has other cool features that are available. And it really breaks down the credit score into those 5 groups that we discussed, the 5 categories. And it will show them where they're doing really good and where are some areas that they can improve and how you can actually improve your credit score. So that's a really good tool. You can also get your credit report from the 3 reporting agencies, TransUnion, Equifax, and Experian. And the federal government mandates that they give you 1 credit report for free every year. So you can get your report that way. What I would recommend is don't pay for services. Be aware of the fine print that these other websites and apps offer because they might give you your credit score or credit report, but they might sell your information and you never know who they're selling it to. You could end up being bombarded with a bunch of offers via email or text messages. And again, you just don't want your information to be out there. So yeah, that's my recommendation. Be sure to use the services that are offered through your financial institution.
Oh, that's very helpful. Can you tell us how long it takes to improve someone's credit?
There is no set time frame, but credit agencies report changes pretty quickly. So improvements made should show up on your credit report within a month or so. The positive changes made now are also more important than the negative impacts from the past. So just know that 40% of your score is based on what you've done in the last 12 months. And then 30% is based on the prior 13 to 24 months. Then 20% is based on the prior 25 to 36 months. So that gives you an idea of the importance in the last 3 years. So there's no instant fix to improving your credit score. It does take time, but with a little bit of patience and work, you can do it. It may take a year or maybe 3 years, but you can do it. It is possible, and I personally have done it myself, so I can attest that it's something that you can do.
So Alvaro, tell me, if somebody already has a good credit score, so what's the benefit to work on it or to improve it?
There's a number of great benefits, but if you're looking to rent a home or and say there's someone else who has a better credit score, and the landlord is comparing possible tenants, they may go with the person with the best credit score to rent that unit, the house or apartment. When it comes to a time to get a loan, a good credit score not only helps you get the approval, but it can help you determine what you're paying for that loan, what interest you get. So the higher the score you have typically means you'll pay less in interest, as many lenders have what is called rate bumps, and people can lower their credit with lower credit scores rather may pay more for insurance rate as well. So there's a number of different factors that come into play.
So essentially, having a good credit score helps you save money.
Exactly.
Wow. Well, thank you, Alvaro, for taking the time to walk us through all the ins and outs of credit score. And thank everyone for watching. Make sure to like, share, and subscribe to our channel. And for more information on how to make smart money decisions in America, because knowledge is power. I am Amavi Gamon. Well, see you next time.